This video talks about net present value. Net present value is the sum of present value of all cash flows of a project. A positive NPV means the project will increase the wealth and you should accept it. While a negative NPV means the project will not recover its investment and you should reject it. Example 1. A project causing you $2,000 now. It will generate $1,000 each year for 2 years. We can see throughout the whole project. The project will earn nothing, as the sum of gross cash flow is zero. In fact, the project will lose money, because the net present value is negative. By multiplying the gross amount with the discount factor, we can obtain the present value. As we can see, the $1,000 in year 1 only equal to $952 now, under a discount factor of 5% per annum. It means if you have $952 now, you can invest to earn a 5% return in order to have $1,000 in year 1. As the NPV is negative, we should reject the project. Example 2. This time, the cash flow in year 2 is $200 more and the sum of gross amount of cash flow is $200. Under a discount factor of 5%, the NPV is $40. As the NPV is positive, we should accept the project. Example 3. The cash flow is the same as those in example 2. However, the discount factor becomes 8% per annum. The future cash flow will be discounted deeper. Even with the same set of cash flow, the NPV becomes negative and we should reject the project. Example 4. The discount factor should be aligned with the timing of receiving cash flow. If the cash flow is received every 6 months, the annual discount factor will be divided by 2. The power of the discount factor also increases with the number of times being discounted, as more periods are involved. For example, we have to discount the $600 in year 2 4 times with a discount factor of 2.5% in order to obtain its present value at the moment. Example 4 has the same total amount of cash flow and discount factor with example 2. The only difference is the period of discounting. The cash flow in example 4 is being discounted more frequently than that in example 2. As the cash flow is received and rolled over earlier, the present value becomes higher than that in example 2. Example 5. Sometimes, the tax rate is given in the question. Therefore, we have to consider the tax impact on the cash flow. When calculating NPV, which involves tax, we will discount the after-tax cash flow as taxation will not flow into our project. Compared with example 2, the NPV in example 5 becomes negative after considering the tax impact as the project actually receives less than it seems. Example 6. Another tax impact is the capital allowance. In example 6, 60% of the initial investment is allowed to be deducted from income equally in 3 years. Therefore, the tax allowance of $400 is another type of income for the project. By adding the tax allowance to the after-tax income, we can obtain the after-tax cash flow for each period. The NPV in example 6 is much higher because there is tax allowance as income. Example 7. A 5-year project which costs $2,000 right now. The project will generate income of $1,000 in the first year. The income will grow at 3% annually for the remaining years. The discount rate is 5% per annum. This time, we assume a constant growth of cash flow. This is very common in estimating cash flow of a project. Of course, we can compute the NPV manually by discounting each cash flow. However, it takes a lot of time if the project's length is long, says 10 years. Therefore, we can apply the following formula to obtain the sum of present value of constantly growing cash flow, where P stands for the first payment, which is the payment without any growth, R stands for discount rate, G stands for growth rate, and N stands for number of periods. Pay attention to the discount rate and the number of periods, they must match with each other. A 5-year project receiving cash annually with 5% annual discount rate means N is 5 and R is 5%. A 5-year project receiving cash every 6 months means the N is 10 and R is 2.5%. By applying the formula, we can obtain the sum of present value. The value we compute will be one period before the first payment. In this example, the first payment is in year 1, thus the result will be the value in year 0. Bear in mind that we only obtain the sum of the present value of the income. We still have to deduct the cost of $2,000 to obtain the NPV. Example 8. A 10-year project which costs $100,000 right now. The project will generate income of $10,000 in the first year. The income will grow at 3% annually for the year 2 to year 5, and 4% for year 6 to year 10. The discount rate is 5% per annum. This time, we are having two sets of growing cash flow. It is not complicated as we can apply the formula to the first set of cash flow to discount it to year 0, and the second set of cash flow to discount it to year 5, which will be then discounted to year 0. The data for the first set is straightforward as shown. We just need to compute the first payment of the second set by growing the amount, and the first payment of the second set of cash flow is in year 6. By applying the formula, we can calculate the NPV easily. Remember, we have to add back the initial investment and discount the second set back to year 0 as shown.